In Phoenix, stories like that of a nurse named Andrea, who reportedly received a 48-hour notice to pay 40% more rent, highlight the growing role of Wall Street-backed landlords using algorithmic pricing. Meanwhile, in Chongqing, construction worker Zhang Yong stares at the concrete shell of his apartment, paid for in full but abandoned. 2 countries, 2 broken dreams, and 1 unsettling pattern. Housing has become a global casino, and ordinary people are losing the bet. Let's break down how this happened, and why experts warn it's spreading. The U.S. housing market has a new player, Wall Street. Institutional investors now own 2 to 4% of single-family rentals nationwide, but their influence is growing fast. In the first quarter of 2024, they bought 19% of homes sold, dominating cities like Phoenix and Atlanta. In Atlanta alone, investors snapped up over 20% of homes, spending more than $1 billion. Their weapon? Algorithms that adjust rents in real time. A recent Nevada Current report highlighted a case where a teacher's rent allegedly spiked 35% overnight following a private equity firm's acquisition. "I've worked here for 12 years," one teacher told the Nevada Current. "Now I'm priced out." Here's what makes this possible. The U.S. Treasury estimated that 1031 exchanges cost $5.8 billion a year in deferred taxes, effectively subsidizing speculation. And with home prices rising, that number is almost certainly higher today. For context, a figure that likely exceeds the current federal spending on homeless services, though direct comparisons can vary depending on the metrics used. Meet China's PreSale model, a trillion-dollar gamble. Buyers like Zhang Yong paid upfront for unbuilt apartments. Developers used the cash to buy land, not to build. For years, it worked. Then, in 2024, Evergrande collapsed. Today, hundreds of Evergrande's projects remain stalled across China, with analysts estimating at least 300 major developments frozen nationwide. Protesters chant, "We want keys, not promises." The government's response? A $140 billion bank bailout. But less than 12% has reached homeowners, as per Caixin Global. While China's central bank now mandates just 15% down payments to boost demand, but buyers in Evergrande-style developments reportedly face much steeper upfront costs, sometimes double or more, depending on project and region, because no one trusts these homes will ever be finished. As economist Ku Jin warns, housing is now a financial derivative, whether traded by Wall Street or Chinese developers. So how did 2 superpowers end up here? And why is this problem going global? The OECD has raised concerns about the increasing financialization of housing, noting that investor activity has surged in numerous countries over the past 2 decades. In Berlin, state-owned housing companies have been authorized to increase rents by up to 2.9% annually starting in 2024, sparking mass protests. In Mumbai, several housing projects have faced delays, with some linked to complex financing structures reminiscent of China's PreSale model. The lesson? When housing becomes a global asset class, local families lose. Is there a way out? Maybe. The U.S. debates banning corporate home buying. China considers converting ghost cities into social housing. Neither is perfect. But as Ku Jin puts it, until we stop conflating homes with hedge funds, the crisis won't end. It'll just change addresses. What's your take? Can housing be both affordable and an asset? Drop a comment.